And it's going to be 1.5 hours. Such a joy to do this. One of the things I enjoy doing is doing this class. And let's get started. Where do we start? So we are doing bonds. We are going to do bond valuation, bond yields, bond duration. And if we are good enough or fast enough, we're going to do bond convexity. If we cover all this in 1.5 hours, ladies and gentlemen, it will really be worth your while. I think it will be worth your while. If we cover all this in 1.5 hours, it will be worth your while. But we can only cover all this if we are participating and if we are quick. And it's just the three of us. And I'm thinking maybe by 22 or somewhere there, we'll have more people join. I thought today it would be more people, but who knows? What do I know? I have stopped worrying about why people don't come, because you will never know the truth of these things. Okay, let's get to a question, a poll question coming your way. Okay, let's get there. Which of the following? So the poll is going to show up. A poll is going to show up. Which of the following best describes a bond? A poll, make your choice, or type in the chat, say question number 1. Okay, it's just one question. Then I'll show another poll for the question number 2. So just say question number 1, or you just choose in the poll, and then we get going. There's no reason to wait. There's no reason to wait for more people. We have more people. We have people who are committed. That's what we deal with, and we deal with people who are there. Which of the following best describes a bond? Make your choice, make your choice, make your choice. And if you don't see the pop-up, put it in the chat, and then off we go. Make your choice. Ladies and gentlemen, in case you are not seeing, there should be a pop-up like this one. See that thing which shows up, then you make your choice. Yeah, choose one of those things. And then we get going. So which of the following best describes a bond? Which of the, let's see. Okay, best describes a bond. Make a choice. I made a choice, so we have 2 responses there. Is Pelele, can you hear me? I think you can hear me. Mohammed, Manessa, can you hear me?
Hi, sir. I can hear you.
Good. Okay. So we can continue. So let's go to another next question. Next question, what's the main difference between I don't know, my computer is trying to pause. What is the main difference? Another poll thing coming your way. What is the main difference between a bond and stock and a stock? I think I was supposed to say in the share, but who knows? I have already said the stock. Stock and share are the same thing. Let's go for it. Make your choice. Make your choice. Make a choice. Let's see how many people have chosen something. 2 people. We have 4 people, so we maybe have more people. We have Lucy who joined us. Lucy. Chimomola. I think that's the right way to say it. I think that's the right way to say it. Okay. What is the main difference? Shares pay, bonds are riskier, shares represent, bonds can only. Okay. Shares represented ownership. Ladies and gentlemen, you know what you're talking about. I think I didn't talk about what was the response for the first one. First one, I think we all got it right. So, which of the following best describes a bond? It's a loan to a company or bank. Or company. Loan to a company or the government. That's a bond. What is the main difference? If all of you said, let's see, let me confirm. Yes, all of shares represented ownership in a company. Okay. Okay, so to just give you an overview of how this, so I want to be confident that you understand how a bond works before we do all the interesting calculations. So a bond is an investment because we're doing investment. So we are looking at it from an investor's point of view. So it's an investment where you pay in money, you pay money to a company or the government because you're expecting to receive, let's look for a pointer. This is the point, I think. Yes, this is the pointer. You are expecting to receive periodic payments. I call them C1, C2, coupons. So the interest, the payments you're getting, we sometimes call them coupons. At maturity, it's going to pay you a maturity value, or it's going to pay you back the money which you invested here. So you invest in day one, you receive some coupons or periodic payments, and at maturity, you are going to get your initial investment. That's how a bond works. So we are saying for the entire period, it's going to pay you. So if you are trying to find an intrinsic value to say, what is the value of the bond at any one given time? So this is the red bar. We are going to say, what is the interest rate? What is the present value of all the coupons we are going to receive? What is the present value of all the payments we are going to receive over time? That is the intrinsic value. And we use this yield to maturity to discount these coupons and the maturity value. That's how to find the intrinsic value. In my videos online, I make a mistake here and say, what is the market value? No. It's called an intrinsic value. That's the correct way to say it. Okay, so to do it, to make it more meaningful, let's do a calculation, an example calculation. So we're saying, calculate the value of a semi-annual bond whose annual coupon is 8%, matures in 2 years at face value of 1,000, and the yield to maturity is 10%. So we nicely represent it this way. It's a semi-annual bond, which means sometimes people get confused about why semi-annual. Semi-annual, it means it pays its coupon half yearly. That's what makes it semi-annual. So we are saying we are trying to find the present value. So how many payments is it going to make? So to find the present value, we need to say how many payments is going to say payment one, first half year, second half year. So now it's in year one. So third half year and fourth half year. So it's 2 years, but it's making 4 payments. And at the end of the period, is going to pay 1,000 rand. That's to really simplify how the bond works, so that we can see it in our mind's eye before we do all the clever calculations. So we are saying, what is its value today when it's going to pay us 40, 40, 40, 40, and 1,000 at maturity? And we are going to use this 10% as our discount. Easy, ladies and gentlemen, we are going to take out our financial calculator and we are going to say FV 1000. PMT, I don't know what your calculator is, but I'll say PMT is payment 40, N being the period 4. Why 4? Because it's going to pay 4 payments. Yield to maturity, that the number, yield with the interest is 10. And you say present value, it's going to give you 964.54. Your question is this one. Ladies and gentlemen, I'm sure if you don't have a financial calculator, you have to do it in Excel, unfortunately or fortunately. Do this one, do this one, do this one, do this one. If you're stuck, you can ask me. I'm here. I'm not going anywhere. So I'm just here fiddling with things. But if you're stuck, I'm here to answer your question. I'm going to shut up so that you can focus. And when you finally find your answer, post in the chat. Post in the chat so that I know where you are. If you are stuck, you can ask your question in the chat so that we know, so that we can move together nicely. Okay, I can see Mohammed is the answer there, but relook at your numbers there, Mohammed. Maybe you might be right, but Vanessa, yeah, disagreeing. Mohammed and Vanessa disagreeing. Let's see the other two. The other two, Sipelele and Lucy. What are you saying? Remember, we are too few, so I can actually see you. That's the thing. Post, Pelele and Lucy. We are waiting. Post your answer there. Or if you're stuck, you can just say, well, I'm stuck here, and then we can deal with it. It's a good thing you came so that we can do this thing together and walk this journey together, not journey. Spelele and Lucy, what's happening?
I'm stuck here.
Yeah, stuck. Okay, let's do it together. And Lucy, what's your comment?
Good morning.
Morning.
I'm also stuck because I joined recently, so I was still settling myself, even looking for the financial calculator.
Okay, but did you find the financial calculator?
Yes, I do have it now.
Okay.
You can do it together. So
we
that
can do it together, yes. So what is the n? N here is 5, but times 2 because it's the semi-annual bond, 10. What is I? I is 6 because remember it's paying half yearly. This 12% is for the year, so it's 12 divided by 2, 6. PMT, what is the PMT? 7, 14% of 100 is 14 divided by 2 is 7. Future value of 100. Present value, you find your present value, then it's 107. We call it a premium bond. And Mohammed was right. Manessa, what happened there? Manessa, what happened?
I say I've got the same inputs, but I'm not sure why it gave me 71.
I don't know why it gave you 71. Yeah, because it was supposed to be above 100.
Yeah, because I did have...
But maybe clear your calculator. Let's clear your calculator and then let's do this thing together. Why I'm spending a bit of time here? Because it's an important concept which we need to know when we're calculating duration or convexity. It's an important concept. Okay, let's do together. Put in your N10 and I6 and use Pelele and Lucy. You should do the same thing. 7 for PMT, FV 100, and say present value. What do you get?
Okay, I'm getting 107 now.
Okay.
Thank you.
Lucy, what did you get? Lucy,
I'm
we are all
getting the same, sir.
You got the same. Spelele?
Yes.
I'm getting the same. I was just
Good.
confused with,
So we are good.
yeah.
We are so good. Okay, ladies and gentlemen, this is the thing we were doing. So what I want you to do now, a small step forward. I want you to answer this question. 10% annual bond selling with par value of 100 matures in 12 years. Calculate the intrinsic value at each of these intervals. So I want you to find the intrinsic value. If yield to maturity is 8%, so you say A, you put your answer. B, you put your answer. C, if it is 12%, you put your answer. So you need to have A, B, and C. Because there's something which I want to then just start discussing. Let's do that quickly. So you do your PMT, your N, your I, your FV, then you say PV, then you write the answer. Then you change your I to, so you change your I to that, you 10, you change your I to 12, then you write your answer, right answer. Then we can discuss something. Okay, let's go for it. Let's go for it. Let's go A, B, C. So do A. So once you put all your factors for 8%, ladies and gentlemen, the only thing you will need to change is the 8, you change the I to 10, then to change your I to 12. Then you post. Okay, I can see Mohammed is posted. Let's go. Now we are under pressure. I hope Lucy didn't leave it because it was too hard. Okay, Spelele, you can post your A, and if once you get it, then you post your B once you get it, and you go like that. And your C. Okay, Spelele, where are you? Okay. I think we're going to continue because otherwise the Spelele will feel very under pressure, which is like that's the problem for a small class. People start feeling too much.
Where do I post?
Or in the chat, or if you look here.
Oh, okay.
In the chat there. So click there and then post like what Mohammed and Manessa did. Manessa SE. Okay, let's wait for Spelele's answers. Okay, let's wait for Spelele's answers. Let's wait for Spelele's answers, then we can proceed nicely. Okay, ladies and gentlemen. Aha. Why do we have a difference now? So for 8%, 1134. And Manessa and Mohammed got 1150, 1000. Of course, we are agreeing there. 1876, 876. Why do I have a number? Which is okay, let's do this thing quickly in Excel. Okay, don't ask me a question. Can you use Excel in the exam? No, you can't. Use your calculator. But the calculator which I have here is the Excel. Okay, let me open a blank workbook. So we are saying it's a 10% annual, so it's paying a coupon of 100. So coupon 100, FV is 1000. And I'm also doing this so that we are all together, Spelele, so that Spelele can also see what we are doing. Our N, because it's an annual, so you can say 12. Our I is 8. Our I is 8. So I'll say 8% because I know Excel is going to give me a grief if I don't say 8% there. So if I say here f of x, I want to find present value and I put it here nicely. So the rate is this one. The NPAR is that one. The PMT is that one. The future value is that one. And I say, okay. Yeah, I had a mistake here, as you can see. Yeah, I don't know why I have that strange thing. Let me do this. Okay. 1150. So I was wrong. Spelele, how did you get 1200? Then if we say, of course, if we say 10%, of course, it will be there, 1000. Then if we say 12%, of course, it will say 876.11. 876.11. Okay, so what I wanted to show here, ladies and gentlemen.
Sorry, sir.
Yes.
Can you please repeat? 100 is PMT.
Yes, so 100 is PMT because we are saying 10% of 1000.
I don't know how I get it wrong because.
Okay, what is your so your 100 is PMT, your 12, put your N is 12. Then if FV is 1000, your I is 8.
Oh.
Now you got it correct.
Yeah.
Okay, cool. So we are on the same page. Okay, so let's say what I wanted to show here is to say, if the yield to maturity is lower than the coupon, your yield to maturity is lower than the coupon here, the price of your bond is above the maturity value. We call it a premium bond. An important theoretical concept. If the yield to maturity is equal to the coupon, 10-10, as you can see here, 10-10, there, we call it, it is the same. So your intrinsic value is 1,000, and if you it's the same, we call it a par value bond. If the yield to maturity is above the coupon, like that 12 and 10, the price of the bond is lower than par value. We call it a discount bond. So as the yield to maturity increases, you can see the value of the bond reduces. Thus, we have this line to say when yield to maturity is increasing, the intrinsic value of the bond reduces. Therefore, okay, before therefore. Yes, Pelele?
I think the reason why I got the wrong answer because I use, on the HP,
Yes.
the blue sign,
Yeah.
YTM. I use that. I press the blue, then I press YTM.
Oh.
Why we're not using the one YTM, then 1I over YR.
Oh, I over 1 over YR.
Yes.
Okay. So long as you found your issue there. Okay. Question now, easy now, theoretical question. 2 theoretical questions from what we learned. If interest rate increases, the price of the bond will answer, they put in the chat. And then you say, so at the bottom there will be 2 arrows, then you go to the next question. When the coupon rate is the same and then you put the answer there, then you post. These 2 questions are just to solidify the theory. The theory in your head, it should be sitting nicely. Because sometimes the question in the exam comes assuming, it's an easy question, but it's underpinned by a theory, which is what I'm trying to ask here. Okay, please answer. They were left with 1 person. Now I can't see who hasn't answered. I will answer when the coupon rate is the same as the yield, the value is lower, the same. Okay, then we say next. 2 of 2. When the coupon is the same as where is 1? Okay. If interest rates increase, the price of bond will. Interest rates increase, will. There we are. Then we say submit. Then we can go now. I don't know who hasn't answered. So I was just, okay, so everyone. Number 1, if interest rates increase, the price of the bond will reduce. Okay, that's question number 1. Question number 2, everyone got it right. When the coupon rate is the same as the yield to maturity, the value of the bond is the same as the maturity value. That's the par value bond. What we just did there. Okay, so we solidify so we say there is an inverse relationship between the price and interest, between the bond price and interest. So when interest rate rises, the price falls. When interest rate falls, the price of bond rises. That's an inverse relationship. What we've already just spoken about there. Okay? Yield to maturity. The bonds yield to maturity. Okay? Calculate the yield to maturity of SA. Okay, so yield to maturity, what we're trying to find when you're trying to find yield to maturity, we're trying to find that discount rate, this thing. We are given everything else, but we are looking for this unknown there. So let's do this. Calculate the yield to maturity for SA breweries whose face value is 1,000. The current value is 840. Matures in 10 years. Coupon is 15%. So we are going to the current price, 840. The coupon is 15% of 1,000. So it's 150 from year 1 up to year 10. At maturity, what is it going to give you? It's going to give you 1,000 in this coupon. Then what do we do with all that information? And this is just a visual representation. So we say FV is 1,000. PMT 150. Ladies and gentlemen, watch out this PV. PV should be negative. Otherwise, the calculator will give you an error. Then n is equals to 10. Then you say, go fetch me the I. The I will be your yield to maturity. If you say do this, your I will be 18.6418. Your question is this one. Your question is this one in red. This one in red. If you have a question, you can ask me. Otherwise, once you do your question, please post in the chat so that we know where we are. Okay, let's go. Let's go. One more person. One more person. One more person. One more person. Yes, pues pelele, goodness, ndaba. Okay, you are typing. Good. We are good. We are good. Let's see if we are all agreeing. Ladies and gentlemen, you are too clever. I won't do this with you because you already got the answer. You already got the answer. So let's go to the next. Okay. So now we are going to talk about calling a bond. Calling a bond is a theoretical thing. So we are saying, remember we said you invest, get your coupon, and at maturity get back your investment. But we are saying calling a bond, we are saying before we get to maturity, the bond issuer will call the bond. Okay, what is calling the bond? Calling the bond, he will visa the bond. Call it by name. Okay, he will then refund you your money. So you invested here hoping that you are going to get all these coupons to the end. But at a certain point, not year 3, anytime upfront, the bond issuer will call the bond, they will give you back your money, paying back your money before maturity. That's called calling a bond. And putting a bond is similar but different. In this case, putting a bond, the shoe is in the other foot. Okay, that's a nice saying, but I don't know what it means. Okay. In putting a bond, we are saying you were invested in a bond. But at a certain point in time, you come out of the bond and buy shares. So it's a putable bond. Now, as an investor, you are exercising. So as an investor, you're exercising the put. But as an issuer, here, when they give you back your money, they call it calling a bond. When you exercise your right and pay back, you say, no. I'm giving you back your bond. I don't like it anymore. You are putting a bond. So all we are saying is you either get back your money by being issued the bond, by getting a refund from the issuer, or you can go to demand your money. So okay. I don't know, my internet was breathing. I don't know what it was breathing about. But I hope I'm back. I hope you can hear me now. It was breathing. Oh, okay. No, but now we are on the next screen. Okay. Ladies and gentlemen, let's do call. Calculate the yield to call for a bond. Yield to call. Okay. Now, yield to maturity is similar to yield to call, but okay, let's do this thing okay, this thing is just blocking me for no reason. No reason at all except to want to irritate me. Okay. So calculate the yield to call for SA Breweries bond whose face value is 1,000, the current value is 840, matures in 10 years, coupon is 15%, callable in 3 years, at a price of 1,150. Okay, ladies and gentlemen, it's the same question, but now we introduce a new thing. So we are putting it on a number line so that you can see what's happening. So the price is 840, the same old price. The coupon is 150, same old, same old. The core, okay, the core price is 1,150. In year what? We are going to call it in year 3. Callable in year 3 at 1,150. So what is the yield to call? Not yield to maturity this time. Yield to call. Now we have a small difference. So the FV, instead of it being this 1,000, is 1,150 is at the call date. PMT still is 150. PV still 840. Our N, remember, we are trying yield to call, so we are at the period to call point, which is 3 years. You put this in your financial calculator, and the clever calculator gives you 27.3328. I think it's correct. Your question is in red. Your question is in red. Hi, Shlako. Mpo, Shlako. How are you?
Morning, Sam. Good on you.
Good, good. Are we together in this question? I saw you just joined recently.
No, we're not together. I just saw the
We're not together.
announcement.
Okay. So take out
We're
your
not
financial account. Do you have your financial calculator there with you?
Yeah, thanks.
You got your financial calculator. Okay, so let's Paul, let's do this thing together. Okay, let's pause. Let me allow Mohammed and Manessa and Spelele a chance to do this and post in the chat. Okay, Mohammed has claimed put a stake in the ground and said 10.372. Manessa SE. What's your name there, Manessa SE? Because Manessa is your surname. If you're a guy, it would be easy to just call you Manessa throughout. Okay, I'll call you Manessa because the first name, you're not giving me your first name. Manessa, post your yield to call there. Spelele, post your yield to call there so that we can do this thing together with Mpo. Mohammed, do you think you will be able to take us through your yield to call calculation so that Mpo will follow nicely? Mohammed is quiet. Vanessa, what's holding you back? Post your thing there. I'm waiting. Pressure. And Spelele. Pressure. It's called legitimate pressure. Vanessa, let's go for it. Legitimate pressure. Mohammed left. Okay. Let's continue. Let's continue, okay? So 10.37, that's the correct answer actually. So we are saying FV, what is the future value? Is the yield to core price, this one. Price, yield to core price. Price, current price, market price, you put a minus there, minus 1099.1. PMT, bond matures in 25 years, you put your 25 years, but it's 20, the bond matures 25 years, the market price, and the, okay, calculate the yield quarterly paying bond. Calculate the yield to go for a quarterly paying bond, which matures with the par value of that. So the bond matures in 25 years, the market price of end yield to maturity, it is callable in 10 years. It's callable by the issuer in 10 years. So since it's a quarterly bond, it means it's going to pay 4 times 10, 40 is our N. So our PMT is 10% of 1,000 is 100 Rand divided by 4, 25, because it's a quarterly paying bond. Then you go and find your I is equals to 10.37. It's still actually I is 2.5931, then times 4, 10.37. Are we together? Now it's just the 4 of us, Pelele, Manessa. Okay, and then Mohammed is back. Are we together? Are you happy with the explanation?
Can you please repeat, sir?
Okay. Let's take. Okay, don't worry, Mohammed. At least you didn't run away from me. I was worried that I put you under pressure. That's the problem of a small class. Some people feel pressured. Okay, let's delete all this. Okay, I'm trying to explain the ECU to core. So we are told that it's a calculate the yield to core of 10% quarterly paying bond. So what's important there is quarterly, which means it pays 4 times a year. 4 times a year. Okay. We're taking our normal coupon is equals to 10% of 1,000, which gives you 100, which is the annual. But we know per period because it's a quarterly paying one. This one divided by 4, 25. Okay. Now we are saying, what is the present value? No problem. Present value, our present value, we know that is 1099. We know that because it's given. That 1099 is this the number. So future value, what is the future value? No problem. Because we have told the core price here is 1340. No problem. 1340. Okay, so what's left? We don't have our N. Our N actually, because it's a quarterly bond, our N is callable in what? 10 years. So we say equals to 10 years times 4 because it's a quarterly bond, 40. So we do what Excel does. We do FFX. FFX. Aha. I hope this one will work. Okay. F of X, I read N par is our N is here. Our PMT is here. Where's our PMT? Our PMT is here. Our present value is here. Our future value is here. There. Then we say, give us the answer. Let's see, we are praying because it is rounded up. We are going to say equals to that times 4. It is rounded up nicely, and the answer is actually correct. The answer is actually correct. Okay. Are you happy now, Spelele, Manessa, and Dumpo? No, I'm not asking Mohammed because he got it right.
Apologies, sir. I had to step away for a moment.
Mpo, are you happy now?
Yes, sir.
Okay, let's go. Okay, let's go. Otherwise, you are moving too slow. Okay, I'm not going to show you that. Okay. Now let's use what we've learned. Now we are going to use it to calculate duration. Okay. So duration, we are saying the bond, remember we said if interest rates increase, the price of the bond falls. So we are saying bonds actually face what we call interest rate risk. To say they are in danger that you buy a bond and the interest rate increases. So the price of the bond you are holding falls. So we say that we call that interest rate risk, and your term to maturity is also a risk to holding a bond. So that actually means that the bond is very sensitive to any change in interest rate. So to manage that sensitivity or that risk, interest rate risk, we use what we call bond duration. Okay. So bond duration is the thing we are going to do. So we are going to say, in theory, bond duration says for every 1% change in interest rates, the bond price will also change by 1%. So if it's a 1% increase in interest rates, it means a bond with 2 years to maturity will reduce by 2%. For a 1% increase in interest rates, a bond with 4 years to maturity will fall by 4%. For a bond with a bond increase by interest rates increase by 1%, a bond with 6 years to maturity will fall by 6%. So we therefore say dot dot dot. Therefore dot dot. You know those 3 dots. Dot dot dot. Therefore, the higher the duration, the greater the interest rate risk. So we are saying the longer the bond is to maturity, the higher the risk that the price fall is very high. As you can see, a bond which matures in 6 years, there's a big fall in price. Oh, but the interest rates have only changed by 1%. So that's the risk we're talking about. So that's the duration we're talking about. So we are, okay. Don't talk too much. Yes, thank you. Thank you for questions. Okay, let's ask our question then. Our theoretical question. There you go. Our theoretical question. If interest rates or you reduce by 2%, what is expected? What is the approximate impact on the bond with 2 years to maturity? That's what we're talking about. Remember, this is to just solidify your theory. Make your choice, make your choice, make your choice, make your choice. Make your choice, make your choice, make your choice. Make your choice, make your choice, make your choice. We have 2 people who chose. Okay, let's see. What will be the increase if interest reduces? Okay, submit. Okay, let's get more to one more person, one more person, one more person. The beauty of the poll is I don't know who hasn't responded, so we can always proceed. So, okay, all of us got it right. If yield maturity reduces by 2%, what is expected the approximate impact on the bonds of 2 years increase? Remember that inverse relationship. If it reduces by 2%, you are expecting your price to increase by 2%, by 4%. Okay. Now the duration formula is this one. Let me explain. I wanted to just skip the explanation and just go to the question. So this V minus Okay, ladies and gentlemen, V minus, can I have your attention? V minus, we're saying, what is the value of the bond when interest rates reduce? V plus, what is the value of the bond when interest rates increase? V naught, what is the current value of the bond, intrinsic value, times change in yield. So this is the formula we are going to be using, okay? So to see it in action, here it is. 8%, I think we are supposed to say an 8%. Otherwise, I'll be unhappy with that. We need to say an 8%. That's good English. Good English says an 8%. Let's correct that. An 8%. Oh, that's better. Now I can read it without biting my own tongue. An 8% coupon, semi-annual 5-year bond. Semi-annual 5-year bond with face value of 1,000, with yield of 12%, current price 852, and suppose the yield is changes by 100 basis points. What is duration? That's actually a full question. Okay, let's do. So you draw this table, ladies and gentlemen. You draw this table if you are doing a calculation for duration and when you are doing calculation for convexity. This table makes your life a lot easier. Okay, so this table is for you to put the values which you find. So you draw your table, you have your n. Remember, n is period I. That's why we're doing the intrinsic value calculation. It's the same thing. Then my PMT is payment, FV, same, but you are drawing now in the table. So we say V minus. What is the value of the bond when the interest rates reduce? V plus. What is the value of the bond when the interest rates increase? Okay, so we are just trying to take this question and put it in there. So we are doing this V naught. 5 years, the semi-annual, so we put 10. What is the coupon? The yield to maturity here is 12%, but it's the semi-annual. 12 divided by 2, 6. What is the period? 5 years, but it's the same annual. It's 5 times 2. No, why do we have 40 here? Or 4 PMT. Anyway, we already have 10 there. Coupon is 40. Why is it 40? Because. Why is PMT 40? 8%. Yeah, I said 8% of 1,000 is 80 divided by 2, 40. 1,000 is the future face value there, future value there. And 852 we are already given there. So now the question is, what happens if interest rates reduce by 100 basis points? 100 basis points, ladies and gentlemen, is 1%. 200 basis points is 2%. 150 basis points is 1.5%. So we are told that if interest reduced by 100 basis points by 1%, so if interest rates move from this 12% minus 1 to 11%, what is the price? Okay, so 11%, so we say 11, we have the same table, 10, it's the same 10, N is still 10, coupon is still 40, maturity is still there, but what has changed is this small little thing. Interest rates have reduced from 12% to 11%. Then we are going to say 11 divided by 2, 5.5. We put our in our financial calculator, it gives us 886. What is the price if interest rates increase by 100 basis points? So that's the V plus, everything else is the same, but we know that interest rates have increased from 12 to 13%. 13 divided by 2 is 6.5. We put everything in the calculator, it gives you this. Nice. Then we are taking all these numbers, we are saying V minus is this one, minus V plus is this 820, divided by 2 V naught, 2 times V naught, 2 times 852, which is there, times change in yield, 0.001 is the same as saying 1%. If you do this calculation, it should give you this number. They will give you this number. But your question is this one. Ladies and gentlemen, if you are not, they tell me if you are a little bit confused or if you are saying anything is unclear. Otherwise, your question is the one in red, as usual. As usual, as per usual, your question is the one in red. and post in the chat. Or what I want you to do, ladies and gentlemen, when you find your V note, okay, let's see, V note, is it given? V note, when you find your V note, post in the chat. V note, post in the chat. Then you find your V minus, post in the chat. V plus, post in the chat. Then you can do your calculation there. Let's do that. Oh, okay. Mohammed is already finished. If you are stuck, ladies and gentlemen, you know I'm here. I'm here just clicking around, waiting for you to ask a question. Post V dot, V plus, V minus, and then you do that whole thing. That's yours. Ladies and gentlemen, that's yours. That's yours. That's If you're stuck, you can ask a question. Okay, I'm giving you, okay, you can see people are trying to post something now. Because if people are too quiet, then I get worried that maybe it's completely. Post your V naught, V minus, V plus. Okay.
What you got so far? Which one you got right?
Okay, let's see. Let's see. There's some. We have more people now. Okay, I'm giving you half a minute. Half a minute, then we can look at the answer. If you are stuck, ladies and gentlemen, you can just ask kids, then we can do something. Okay, the minute is up. The minute, let's do this thing together. There we go. Let's see. Mohammed, your numbers were not correct. And your value, I know why where your V minus V plus and V naught, I think there was an error there. Manasseh's V naught is correct. And Pelele's V minus is correct. Okay. Let's do this thing step by step. Step by step, step by step. Let's nicely put it there. Nicely. And let's move it nicely. Let's delete that nicely. If there's anything you want to ask here up front while I'm doing this nice thing, you can. So we say yes, simple. Okay, let's cover this so that we are not cheating. And so this, let's cover the whole thing like that, and the whole thing here like that, so that we are only seeing. So we are going to say simple. We are doing this thing together nicely. We are going to choose this. So we are saying V, I saw that I went wrong, did not divide by 2. V minus V plus, sorry. Okay, we cut this and drop it there. Oh, it didn't divide by 2 there, Mohammed. V naught. So we are going to say our N, we know our N, our I, our PMT, our, what else do we need? Our FV. So what we are trying to find here is PV. PV, since we are trying to be perfectionists, we are going to bold it nicely. Bold. So we start with the V naught. So I told it's a 15% semi-annual. Once we are told it's a 15-year, 10% semi-annual, 15-year semi-annual, we can go immediately and say year 30 because it's semi-annual. 30, 15 years semi-annual, which means it pays twice every year. So we multiply 15 by 2, 30. Okay, we are still doing V naught. 10% semi-annual with a par value of 1,000. So we know that's 10% of 1,000. 10% of 1,000, ladies and gentlemen, it's 100. But it's a semi-annual, so every period it's paying every period is paying 50. I am cheating here. I am just doing, however, to confuse people. 50, 50, that's the PMT. What our I yield to maturity is 11%. So, but it's a semi-annual. So it's 11 divided by 2, 5.5. We have to put percent here. I'm in Excel, ladies and gentlemen. So if I don't put that percent, it's going to complain. What is the present future value? Okay, future value you can already feel for everyone because we know it's going to be the same. 1,000, 1,000, 1,000. Now, the first thing we are going to find here is what is the present value. Because we are in Excel, ladies and gentlemen, will allow me to just use the technology. What is the present value? Rate is there. NPA is there. PMT is there. Our future value is there. So we say, okay. And we don't like those pounds. I don't know why the computer likes pounds, but who knows? Okay, 927. But now we are going to V minus. If yield to maturity reduces by 50%, so that we get our V minus 150 basis points. So we are saying yield to maturity is 11% minus 1.5%. Last time I checked with my teacher, it was 9.5 divided by 2. I'm going to be lazy and say 9.5% divided by 2. If we do that and come here, I'm not going to be lazy. I'm going to do by FFX for the last time. We're going to say, what is the PV? Nice. Well, there it is. Our NPA is there. We already know our PMT is there. We already know our FV is there. We already know it's supposed to be 1,000 there. Okay, it's supposed to be 1,000 here. And we are going to note like that. And we are going to fix that in the meantime. Okay. But since we are going to change, okay, no, before we change. So what is the I if yield to maturity increases by 11 plus 1.5% is 12.5%, ladies and gentlemen. 12.5% divided by 5 is 6.25, but I'm going to be lazy and say 12.5% divided by 2 here is 6.25, which was correct. Then I'm going to be lazy. Allow me to be lazy. Copy the formula. Copy it there. Okay. So Spelele 92, okay, you're fine. 832, we are differing on the 832. I don't know why Spelele we are differing on the 832. Okay, so now we are going for the formula. Yeah.
I'm also getting the 832.
You also get what? 832.
Yes.
Okay, let's see. So it's 11 plus 1.5% is what? No, I see the mistake there. Yeah. Now now we are agreeing to the dots. Okay. Now we are all agreeing nicely then. Okay, so now we are going to find the bond duration. So remember our formula for bond duration. Ladies and gentlemen, in the exam, you are not allowed the formula sheet. So you need to know the formula. So we are going, it's V minus. Okay, ladies and gentlemen, to make our life easier, let's convert this to positive. Otherwise, it will be in serious trouble. Equals to that times minus 1. Let's convert that to okay. Otherwise, we are going to get such a crazily wrong answer. So we are going to duration is equals to, remember the formula is equals to V minus V plus divided by 2V naught 2 times V naught times change in yield, which is 0.015. Close the bracket. Any questions? We got the same, the answer at the same time. Okay. Any questions, ladies and gentlemen? I think we are. Any questions? Okay. Let's make up ambili. Okay. So this is to make your life a little bit easier, to giving you breathing space. Effective duration. So effective duration tries to estimate the impact of on yield to change in blah 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 blah. But the formula is like this: minus duration times change in yield, which looks like this. This is from your mock exam 2010. 12% coupon that pays interest annually has an effective duration of 1.71. If the yield to maturity increases by 100 basis points, which is 1%, what will be the appropriate change in the price due to duration effect? Okay, we know it's here, the formula is here. Minus duration, we are given the minus duration times 1%. There it is. Your question is this one. The formula is there. The only thing is I don't have the short form there. Your question is in the red, ladies and gentlemen. It's just that one is just plug and play. Okay. That's blue, nice and blue. But I think we need, what's this font? Segui. Okay, SEG. Segui UI. So that's our formula there, nicely there, short form of the formula. Post in the chat, ladies and gentlemen. This is a simple thing. You are just going to say minus duration times change in yield. You already have your change in yield, the duration there. So it should be like a 2-second calculation. Let's go for it. Then we can do convexity, and then we can call it quits. Let's go for it. Let's go for it. Mohammed, what's happening here? Quiet. Okay. Mohammed is not quiet there. Spelele, what's happening? Okay, ladies and gentlemen, we have enough voters. Everyone is saying 11 point, yeah, which is correct. Which is correct, 11.8 actually. This is just a simple calculation. It's positive 11.8. Tick. Okay. Okay, now let's do our last thing. Our last thing, because we're left with 14 minutes. Our last thing. So duration, when we're calculating duration, it estimates that the price of the bond will go down a straight line. This I'm just telling you theory. This theory doesn't come in an exam, but so that maybe you might be interested in understanding what is this convexity story. So when we're calculating this duration, if you plot our duration, it will give us a price which goes down in a straight line. But in actual fact, the price of bonds don't go down in a straight line like what we'll find using our duration formula. It is a curve linear change in price. So it says if the interest rates are at low levels, the price doesn't change as fast. Okay, changes very quickly. So we're saying if interest rates are very low, the price changes, small change gives you a small change in interest rate at a low level, gives you a very high interest change in price. But as interest rates increase, it means the price doesn't change as fast. So it's a curvilinear. So convexity tries to correct duration to get the actual change in price. Don't worry about that theory. Don't even worry about that theory. I'm just giving you the theory so that you are okay. Since you came, I can give you a bit of theory. So the formula for convexity is this one. As you can see, it's very similar to duration. So it's what is the price what is the price of the bond when interest rates reduce? What is the price when interest rates increase? Minus 2V naught. What is the current price divided by 2V naught change in yield? Then there's a squared there. Let's do this thing together. It's what we're doing, only that the formula is slightly different. We still use the same table. A 10% annual coupon 10-year bond annual. So per annum is not the same annual, so it's a straightforward calculation. With the face value of 1,000 is trading at 887. As yield is 12%. Suppose the yield is changes by 50 basis points. Remember, 50 basis points is 0.5%. Okay. 50 basis points, you say 50 divided by 100, you get your 0.5%. Okay. What is the duration? So that's the change in yield is 0.005 and V naught is 887. So our V naught 10, we already know. 12, you already know. 100, we already know. Is 10% of 1,000. You already know. We've been doing these calculations for a long time now. If FV is 1,000, so 887. If interest rate or yield is reduced by 1%, N is still the same by 0.5%, 50 basis points, 0.5%. So it moved from 4% to 11.5%. So PMT is still the same, F is the same. If we put all this in a calculator, it gives us that. If the yield increases by 0.5%, we put this all in our calculator, it gives us that. We do that, we're just plugging into this formula there at the top. Divided by that to the power of 2, this is to the power of 2, with 107 divided by that gives you that. Your question is this one, ladies and gentlemen. Your last question is this one. It's the same thing. If now I think when you get your V minus post, V plus, it's also straightforward. It's not a semi-annual, so it should be really straightforward. What is the convexity? 50 basis points is the same 50 basis points. Let's do it. Yeah, this one is extra easy. So let's do it and post V plus, V minus, V plus, V naught. V naught is already given there. So we only need V minus and V plus. Let's go for it. V minus, V plus, V naught we already have. Post in the chat. Okay, Mohammed already has a convexity there of 21.8. Let's go for it. If you all finish early, then we can do convexity effect. But if it takes time, then this is our very last question. Remember, you can still post your V minus, V plus, then so that I know where you are. Okay, everyone else, let's go for it. Let's go. Mohammed looks like he's nicely done there. I'll give you 1 minute, ladies and gentlemen, because time is actually getting a little bit jealous there. half a minute. Okay, ladies and gentlemen, let's do this thing. Let's do this thing together quickly so that we can close. In case some people are okay, in case some people are remarked. So yeah, Mohammed, right on there, right on task. Okay, the only thing I can tell you, Mohammed, is remember 4 decimal places. To round to 4 decimal places. In case the answer will need 4 decimal, remember to always be in the back of your mind, keep the 4 decimal places in your mind. And Manasseh 1971, yeah, you're on the right track, and I am sure Manasseh, you will get to the answer. Okay, but let's do this thing together before we close. Let's do this thing together before we close. Let's do this thing together. So together, let's do the lazy thing. The lazy thing is to delete all this, but leave that. So 8%, 8-year bond with a face value of 1,000. So per annum. So per annum, so we know that it's 8 and there is 8. And we know that that one is 8 and that one is 8. I is yield to maturity is 8, so we know that it's 8% there. PMT, it's 8% of 1,000 because it's a per annum, so that's why I was saying it's extra easy. 8% of 1,000, I think, is 80. Then we know that also here is 80. We also know that there is 80. Our future value, of course, is 1,000 there. We know that there is also 1,000. We are in our table, 1,000 here. Then we do our PV calculation for this one. Of course, that one will give us I don't know why we're doing PV, but let's just do a PV calculation to just make me happy. E rate is 8, NPAR is 8, PMT is 80, FV is 1,000 there. It should give us the 1,000, which is correct. Then we go here and we say, okay, yield to maturity changes by 50 basis points. So it moved from 8% to 7.5% there. Nice, nice, nice. We are going to do FV again, F of X. This time we are not yet lazy, but the next time we are going to be lazy. The rate is 8%. NPAR period is that. PMT is 80. FV is 1,000. Nice, nice. Then we do that. If yield to maturity increases by 50 basis points, it becomes 8.5%. What is the value, ladies and gentlemen? I'm not going to, otherwise some people are going to be mad with me. Okay. Now we are going to try and find convexity. Convexity, we open our blanket. Convexity is V minus, okay, where is my equals to? Equals to V, okay, open bracket actually. V minus plus V plus close bracket minus, we need to have an extra bracket somewhere. Minus 2 times V naught. That's our numerator because we are trying to be lazy nicely. Our denominator, okay, what's our formula for denominator is 2V naught change in yield squared. our denominator. So this is our numerator. Our denominator is 2v naught equals to 2v naught 2 times v naught. We are going to be in trouble there. We are going to, Mohammed, you are letting me make mistakes here. Let's multiply by -1 so that we are out of, we at least we know what's happening when it happens to us. When it happens to us, we will know exactly what's happening. So we are going to say equals to the numerator plus that minus 2 times looks like I'm also tired. I don't know why I'm tired when I was just playing here. Yeah, okay, the answer was correct, but it's always better to be careful. So the denominator we said is equals to 2 times 1,000, 2 times 1,000, which is that one, times change in yield 0.005, I think, squared. Then we say equals to that divided by that. Any questions, ladies and gentlemen? Any questions? That's the same answer we got. Any questions, ladies and gentlemen? Any questions? Any questions going once? Any questions going twice? Any questions going thrice? Ladies and gentlemen, all the best for the weekend. All the best. The exam is actually approaching. I'm surprised people are not yet connected. Or maybe I'm surprised. I'm surprised people are not yet connected or are not yet coming. But I'll see if I can do another lesson next weekend, so that we can just close this thing off and then we focus on something else. Otherwise, ladies and gentlemen, enjoy your week. My concern, okay, let me leave this on recording. My concern is if we don't do more lessons quickly, it would then mean that we are not going to have time to do the derivatives and all the other clever things in the module. That's my concern. Okay, let me then stop the recording. So if you are coming, please come. I think I'll do a lesson next weekend, but I'll start my lesson at 10 a.m., not 8:30, 10 a.m., so that we get this thing done. Otherwise, ladies and gentlemen, it has been a pleasure.